Welcome to the Daily Brief, where I'll go over the action in the market for Tuesday, March 21st, and then we'll see how things look for Wednesday, March 22nd. We are turning back positive now. The charts are showing a lot of improvement. We had another up day. The internals are starting to strengthen, but we're coming right into Fed decision day, and what's that going to do to the market? Are they going to skyrocket up? Are they going to go down? Are they going to end up going sideways? We don't really know because the Fed's pretty much backed into a corner right now where they're trying to fight inflation. We have this banking problem that has really put a dark cloud over the markets, but at the same time we have this QE going on, which could give some support to the markets as more liquidity comes into the market. So we'll see if Wednesday brings anything closer to being understood as far as what's happening. First of all, just a little housekeeping note. The supplemental video that I usually prepare before the market opens on Monday, I'm not going to do that video for right now. I'm going to merge the information in that video with other videos. And then also, about a month from now, in April, I will be traveling. My intentions are to still do the daily videos. I don't always know if that will happen because of the availability of internet access, but I'm hoping to at least do the daily videos, and I'll do some of the other videos if I'm able to do that. All right, let's go back and talk about what happened. Right at the open, we had a gap higher open with prices going above R1. Then they immediately went above R2 at 39.81. As the day went on, prices then drifted sideways for most of the day. We were above and below R2. Then near the end of the session, we moved higher and we closed above 4,000. We were up 1.3% on above average volume, so that's still continuing. The technicals, as I said, are switching back more positive, and I have lots of charts here to show you that because of this inflation and interest rate scenario that the market's fixated on. But at the same time, we also have this banking problem that's kind of putting a tug-of-war in the markets. Here's the intraday session where we immediately went above R1. We also went above R2. Then we danced along R2 for a lot of the day and then eventually saw some buying coming in, which took us back above 4,000. Here's the growth versus value chart showing how they both did fairly well. Growth, at least in the large caps, did outperform value. Here's the large cap growth and value. The mid cap growth did underperform, but in the small caps, the growth did outperform. And the reason why we fixate on this is because it's growth areas that really push the markets higher, and we get a lot of our thrust from growth stocks. Here's the intraday chart of the SPY. We were pretty much flat going up to midnight, and then as things in Asia started to wind down and Europe started to get into gear, we saw the SPY starting to go up. That gave us the gap higher right at the open. We chopped all around here, saw some strength late day, and now we're going back to a sideways move as we're entering the overnight session. What are some comments that we can make? The S&P did regain 4,000, but we're still right at that 50-period simple moving average, which is acting as resistance. Bank stocks did rebound after just getting hammered for the last number of sessions. Then there was a Bloomberg report that came out that indicated that the Treasury Department is looking at ways to guarantee all bank deposits, if necessary, without congressional approval. Now, on one hand, you might like that. Hey, they're going to protect my money. On the other hand, they're like, wait a minute, we need Congress to come in and debate this stuff and pass some laws that gets it closer to the people. But on the other hand, you say, well, it takes Congress forever to do anything, and then they screw it all up. That's kind of the back and forth that is happening right now. And then Treasury Secretary Yellen, in her very angelic voice, said that the government is prepared to intervene again if smaller institutions suffer deposit runs that pose the risk of contagion. The market seemed to like these two things that were happening, and that gave some support for stocks going higher. The question we're asking now is, will the Fed raise rates, or are they going to pause with their rates? And then what will Fed Chair Powell say at his press conference after they make the announcement? On a short-term basis, believe it or not, we have the Stochh RSI, which has already gone up to an overbought condition. We don't have anything oversold right now. The dollar was down and interest rates were up. And we still have the 30 to the 5. It's right at 0 now. So you can get the same rate for the 30 years you can the 5-year, but all of our other yield curves remain inverted. Sentiment is still negative. It's ticking up. It's at 38 right now, where it had been at 29. Our trend, we've switched over positive. The green line has gone back above the red line, so that's turning things a little bit more positive, but we're still below 20. We're still below the moving average, so it's not a strong trend as of yet. Our bias is now positive because we had 2 pretty good up days in a row, and I've switched our momentum to either mixed to positive. There's a real variable with how the markets are going to react to what happens on Wednesday with the Fed and then what is said. That usually is short-term in duration, but it can cause a lot of gyrations in the market. We'll have to see after the close, do things shift back more looking positive, or are we going to go back to looking more negative? The economic reports that came out, we had existing home sales really shot up 14.5% on a month-over-month basis to a seasonally adjusted annual rate of 4.5 million. This is higher than the 4.16 million that they had expected. Last time they were at 4 million. Sales increased on a month-over-month basis for the first time in 13 months. Total sales were down 22.6% from a year ago. Here's an isabelnet.com chart. This is a weekly chart of the S&P, so I show a lot of this information. It just looks a little bit different on here. They're still suggesting that we're in a longer-term secular bull market as long as we remain above the 200-week moving average, which is the green line on here. There are different support and resistance levels here. We're still above this declining trend line. And as long as we stay above that, we have more of a positive slant on the market. Here's another chart asking the question, is the recent banking stress the catalyst for consensus earnings to finally get more realistic? The yellow line over here just shows that these are the earnings forecasts. And a lot of people think this is just unrealistic. Or if you look at this dashed orange line here, it is declining. So what they're suggesting by this chart is, will this yellow line come down and start to match up more with the orange line, which could put some stress on stocks because that means they're lowering the earnings per share. With lower earnings, you also have lower stock prices. That also produces a higher PE ratio, which also can make stocks look expensive. Here's another chart where they ask the question, are you more likely to increase or decrease equity exposure over the coming days or weeks? 38% say they're willing to get more into the market. This chart just says, after a correction, U.S. stocks appear expensive. This is similar to a chart that I show in the weekly video. This is the S&P 500 price to sales ratio, because most companies have to sell something in order to make money, whether it's a product or a service, and this is still at a very elevated level. So if you base things on this, stocks are still expensive. Here's the technical overbought, oversold composite. We're getting pretty low with the reading now, and that could be giving some support to stocks. When we get extreme negative, prices have a tendency to bounce up out of that, which is what we're seeing currently. This is another thing that on a common sense level, it just says the Fed funds rate is still less than CPI. So if you have something that's bearing interest and it's lower than CPI, which is the inflation rate, you're losing money. And that's borne out by this chart showing how we're still below the zero line. It is improving, but it's still negative nonetheless. Here's a chart just looking at different asset flows. We're still seeing a lot of money going into money markets, a lot of cash on the sideline, which could be positive for stocks if we really get set to go up and the market experiences some improvement. A lot of that money may come into the market and give some more support. One thing that we want to ask from time to time as we go through different situations, like what's happening in the banking sector right now, how much exposure do the different indexes have? The one that I'm focused on is right over here on the left, where the S&P 500 has a 3.3% exposure to bank stocks and a 10.5% exposure to financials. Where are we at? As of after the market closed on Tuesday, there's an 85.6% chance that the Fed is going to raise rates 25 basis points. There's still 14.4% saying that they will leave rates unchanged. I get a daily email from Edward Yardeni, and this came from the latest email. It just says the banking crisis might have been equivalent to a 100 basis point hike in the federal funds rate. They're just guessing at that, but the financial conditions have surely tightened a lot as a result of the Silicon Valley Bank earthquake and its aftershocks. That's a little pun on the West Coast, having a lot of earthquakes. Further hikes in the federal funds are no longer necessary. That's Edward Yardeni's stance. To get it into restrictive territory, as Fed officials have been aiming to do so since they started the latest monetary policy tightening cycle a year ago. Down here is the 30-year mortgage rate minus the 10-year bond yield, showing how it's really high, back up to where it was in about 2008. That was the great financial crisis. This could suggest that we've gone up high enough with interest rates and now need to start coming back down. Now that's his opinion. There are others that don't agree with that opinion. Another part of his email said the banking crisis and the widening spread in the mortgage market suggests that Fed policymakers should pause tightening to avoid any further turmoil in the credit markets and even greater financial instability. Today's stock market rally suggests that stock market investors are betting that the banking crisis won't cause a recession if it forces the Fed to cease and desist from any further tightening. The relatively subdued yield spread between junk and treasury bonds is consistent with this scenario for now. They're showing how it's not really high. This chart just shows the spread between high-yield corporates minus the 10-year treasury bond. So again, he's a very respected economist, and some people really like what he says. I like to read everything that he does, even though I may not agree with all of it or even understand all of it. This chart right here is given some reason for the market going up in Tuesday's session, where it says the recession fears are up in March. This is the percent that are saying a recession is likely in the next 12 months, and the percent that want corporates to improve their balance sheets. And this is starting to go back up. They like the improving balance sheet part. They're not as happy with the recession part. Now, looking at some of our charts, the Ulster Index is still above this moving average, suggesting that there's still some fear in the market, but we're seeing a real decrease in fear with the VIX. The line chart is going down, as is the bar chart, and volatility is really starting to drop off, both on the bar chart and on the line chart. The equity put call ratio, after giving us a spike, is now continuing to come down. That could give some support to stocks. Also, we're seeing fear really start to go down. That could give some support as well. And here's another fear gauge that we look at. After spiking up, it's ever so slowly starting to come back down. Here's the ADX showing how we're just barely crossing with the green line over the red line. However, the ADX is still below the moving average and declining, but we've now switched to a positive default for our trend. The daily chart showing how we came right up to the 50-period moving average, and that's acting as resistance. We're still above this downward sloping trend line. On the bottom, you can see where volume is still above average. Here's a 2-year look at that same chart, pretty much showing us the same thing. Our Arun really hasn't changed now for the last couple of days. How sellers are decreasing, but so are buyers. The thing that we take away from this chart is we had an extreme negative reading and we're starting to bounce back up, and that could give some support to stocks going higher. Our stochastics, we're turning positive with the short term, starting to turn more positive with the intermediate short term, and turning back up in the long short term. And again, the reason I say that is this is a further subdivision of the short-term time frame. The force index has now gone back above 0 and is turning positive in the short term. Here's the Stoch RSI, where we're starting to get extreme, and it can stay up in this area for an extended period of time. Here's our Keltner bands, where we had been able to climb back up to the midpoint. That's this dashed line here. We're starting to go back above that, so that's turning things more positive. And we're able to get back above the 20-period simple and exponential moving averages. So in the short term, we're back to positive now. The 50-period moving average, we're right in between the simple and exponential moving average, where we're above the exponential moving average, but the simple moving average is still providing overhead resistance. And we're starting to break above the 100-period moving averages. Here's our moving average tree showing pretty much the same thing as the market tries to go back up and recapture some of these moving averages. Swindlin Trading Oscillator, based on price and volume, are positive. They're above 0 and advancing. We're seeing a lot of improvement with our oscillators. The slope, which had turned up a few days ago, that's positive. The TSI is just crossed over positive. The MACD is crossing over positive on the daily chart. We're turning up with the PMO. We're crossing positive with the PPO. But our longer-term oscillators are turning up ever so slightly, but they're still negative. Here's another big change. The parabolic SAR, we have a dot underneath, so that has now switched to positive. Chaikin oscillator, above the dashed line and advancing, that's positive and still has more room to run before it gets extreme positive. The vortex, we're seeing a cross similar to the ADX, where the green line's going back over the red line. Ichimoku cloud, we're coming back up into resistance now. Can it break out above this green cloud? The PMO, looking a lot better. Hasn't crossed positive yet, but we're just getting near the point where we're crossing over based on price and a little bit further to go based on volume. A lot of times what we see on this chart is the price and volume charts cross before we see it in the PMO. Looking at our PMO study, looking a lot better with the PMOs that are rising. The buy signals are also starting to go up. We're seeing a little bit of a bottoming here with the PMOs that are above 0. The BPI, after being below 30, has now crossed back above, so this is turning back more positive. The broader measure of the BPI is turning back up as well. Chaikin money flow, starting to turn more positive with a green bar. Balance of power, above the dashed line and advancing, that's positive. TTM squeeze, still negative, but showing a lot of improvement. Another good day or two, and this could actually start showing some blue bars. The go, no go is still neutral. And we're getting back above both the double and triple exponential 50-period moving averages. If we keep going up, we might hit some upper resistance at the 4075 level. We are above the 200-day simple moving average. We added 3 new X's on the point and figure chart. That's positive, but there's no signal that's been generated yet. With our short-term fib levels, we're coming right up to this 4004 level, which may act as overhead resistance, which is right about where the 50-period simple moving average is at. Longer-term fib chart, we also have some resistance just below where we're at right now. This is at 39.98. You could round it up to 4,000, and we closed just above 4,000. Can we still build up off of that? Our longer-term fib chart, if we keep going up, we have resistance at 40.20. If we really start to fall down, we have support at the 38.26 level. The Elder Impulse system for the S&P continues to be positive. The McClellan Oscillator has crossed back above zero, so that's turning positive. Our broader measure McClellan Oscillator is also looking better, but hasn't crossed positive yet. The summation index based on price and volume are starting to turn back up, so this is turning positive. We're not really seeing a breakout in the new highs as we go higher, but we are seeing some improvement, at least as we're seeing less new lows. Our 5-period is still negative, but turning up, and we're going pretty much flat to slightly down with our 10-period average. We're showing some improvement with the advanced decline line. We closed above this moving average based on price. We still have a ways to go based on volume. The shorter-term exponential moving average of the advanced decline ratio is the blue line, and that's showing some improvement, and the red line's turning up, but it's still below zero. Accumulation distribution is showing more strength. We're above an advancing moving average. Volume is still above average overall, even though the histogram is coming back down. It's still calculating that really massive amount of volume we had last Friday when it was quadruple witching. The ratio between the financial sector and the S&P is bouncing up slightly. The bank ETF also was up over 5%. This regional banks ETF was up almost 6.5%, and the other ETF was up 5.76%. And then a ratio between the regional banking ETF and the financial sector is showing some improvement, but it's still down pretty heavily. First Republic Bank, which has been heavy in the news right now, it was up 29.47%. The Dow was able to get back above its 200-day moving average, so that is positive. Can it keep going up to get above its 50? The diamonds for the Elder Impulse system have now switched to positive. The NASDAQ, recent golden cross, showing some strength. NASDAQ 100, recent golden cross, breaking through resistance. That's showing a lot of improvement. The Qs for the Elder Impulse system continue to be positive. We're coming up to this 12,867 or 868 level, which is where the NASDAQ 100 stalled out before. Can it break through and keep going higher if we get to that level? Small caps also rebounded up 1.66%. Looking at the Russell 2000 small cap index, this support level did hold and we're bouncing up off of that. We still have the 50 and 200 period moving averages above current price. The RSI, after giving us an extreme negative reading, is starting to go back up. The MACD is still in a downtrend overall, but could be starting to turn back positive. The Elder Impulse system for the small caps are still neutral, and the small cap ratio, after really showing some weakness, is starting to bounce back up slightly. The mid caps, recent golden cross, trying to get back above its 200-day moving average. The Elder Impulse system for the mid caps also continue to be neutral. Looking at the home builders, showing some strength in the S&P, the home builders also advanced. The ratio still holding up okay, and not a lot of change as far as their relationship to each other. Copic curve, coming off of a recent buy signal. Bond yields are up around the 3.6%. And here are bond prices, after really going up, have started to come back down slightly. Looking at the long-term chart, this is a weekly chart of the S&P. We're watching this MACD. It's still right on top of the moving average. With the up day that we saw on Tuesday, this could be turning back up, but we need to see more in order to convince us that this breakout above this downward sloping trend line was not a fake out and should be taken seriously. An update of our possible positive scenarios, showing some real improvement with price. When we look at our 19-day exponential moving average of the advanced decline ratio, we're still below zero based on volume, but it is showing some improvement. Looking at our growth to value ratios, still looking pretty healthy when you compare the Qs to the S&P, showing some improvement with discretionary to the S&P. pretty much chopping sideways, but still looking healthy overall with large cap growth versus large cap value. Here's some other growth value ratios. Large caps still looking okay, mid caps and small caps, even though they're declining slightly. This is a concern. We need to see some improvement with this chart. This is the 50-period exponential moving average of the new highs minus the new lows. It has now dropped below the zero line. However, for the first time in a number of days, this indicator has now gone above zero. So that could help things, but we need to stay above zero with this indicator for the red line to go and turn back up. 2-year Treasury yield, after spiking up and coming back down, that could give some support to the S&P. And our staples also declined a little bit. We're still working off of this massive spike right here, which could give some support to stock prices. What's our outlook for Wednesday? The technicals are turning positive. In the short term, we're already positive. Intermediate term, we still have a ways to go. We have the weekly MBA mortgage index coming out, and then the big one will be the FOMC rate decision at 2 p.m. Eastern. The whole list of geopolitical events where you have inflation and interest rates on one side and this whole banking issue on the other side, and both are going to be heavily dealt with in Wednesday's session as Chairperson Powell gives his press conference. Looking at the Stock Traders Almanac for Wednesday, March 22nd, we're neutral to positive with both the S&P and the Dow, where we're a little bit more positive with the NASDAQ. And then all the other things, because we're turning more positive, I'll go over these briefly. For the month of March, we tend to be up 64.4% of the time over the last 73 years. We have the 3-0 trifecta that we're working from. We had the Santa Claus rally, the first 5 trading days. That gave us a score of 2. January closed up, so that gave us a score of 3, giving us a 3-0 score, which is what the Stock Traders Almanac calls a 3-0 trifecta. Also, when all 3 of these indicators were positive over the next 11 months, so February through the end of the year, there's been an 87.1% chance that we're up, but if you take the full year, it's up 90.3% of the time with an average gain of 17.5%. Also, the markets like that we're split between Democrat and Republican in Congress and throughout the government. We're on trading day number 16. We tend to be positive in a pre-election cycle. Are we starting to come into this gray line, which could produce some fairly good returns? And I showed you a chart yesterday that the market tends to bottom in March. And also, based on the Stock Traders Almanac charts, we're coming into this potential sweet spot where the S&P had experienced a gain of 20% when we have everything lining up the way it is now. Our scenarios. I took the down one off because we're turning back more positive. We can't really go with the up one yet, even though we are turning more positive. We're sticking with the sideways trend right now because the ADX is still below its moving average and weakening. We're below 20, but it has switched over to positive. So our conclusion, the S&P is turning positive. We're already positive in the short term. We're turning positive in the intermediate term. We're positive in the long term because we're above the 200-day simple moving average and we had a recent golden cross. Thank you. I hope you found this helpful. I hope you have a very good day and I will talk to you in the next video.